If you have a silver squeeze, what's going to happen is that the contract will be suspended and they'll cash settle. We saw that in the tin market. I mean, that's the way it works. That disruption, however, would, I think, be extremely beneficial to the silver market. People need to understand that. When I look at the silver market, I don't have the same ability to say why it'll go higher that I do with gold. What I do know is that in my 50 years in metals markets, that precious metals bull markets are led by gold. And when the narrative becomes pervasive enough that the generalist investor comes into the precious metals space, market leadership switches from gold to silver.
Silver is more an industry metal than it is a precious metal, if you like. Do you think central banks could also go into silver a little bit more as a store of value and diversification for their own portfolio?
Traditionally, they have not, although the Russian central bank has suggested that it might buy silver, which of course caused a lot of excitement in the silver market. Three problems with that I see. First of all, is that tradition and precedent is focused on gold. It has acted as a store of value for a millennium, and it has been the stuff of bilateral trade for a very long time. And I think tradition plays an important role. The second is that the very volatility of silver, both up and down, makes it a less reliable central bank asset. Central banks probably wouldn't mind the upswings in the silver price, but I think you'd see domestic politicians around the world very cranky if there was a material decline in the silver price. Finally, it's inefficient in that it takes up too much space. When I still worked for Sprott, we had several $billion worth of gold and several $1 billion worth of silver stored at the Royal Canadian Mint. And I got to go look at it. Jan, I have to tell you that our pile of gold was distressingly small. It really wasn't a very impressive looking pile at all, particularly when you thought about what it was worth. When I was then ushered into the silver vault, that was a very different circumstance. That was extremely gratifying. There were huge piles of silver. And Sprott, relative to, say, Germany or the United States or Japan or India, was a bit player. And I think that the cost of shipping and storing silver relative to the cost of shipping and storing gold means that gold will be a much more important central bank asset for a very long time.
Well, very good point. Very good point. I remember having like a $1 million in my hand worth of gold, right? It was quite heavy, but it was not much, to be honest. So it really is kind of small, if you like, a small stockpile. But what do you think of silver in general? I mean, there have been talks, and we talked on our YouTube channel about this as well, about a potential silver squeeze, right? We can see the silver industry mining about 850 million ounces of silver every year. We can see a little bit of recycling adding up, but we can, on the other hand, see a growing demand of the industries that need silver, and it's way above 1 billion ounces a year. I mean, there have been years where there was not really a rush on silver, so there are potential stockpiles in some banks or wherever whatsoever. What do you think? Is there the possibility of a silver short squeeze? Is there a possibility of the vaults being empty? What do you think about this whole story?
Two different questions, I think. The first question, is there a possibility of a silver squeeze? Absolutely. That comes from the fact that the silver futures market is extremely liquid. In a common day in the United States, silver futures valued at 100 times the silver available for good delivery trade every day, not every month. But rather the trading volume in the paper market exceeds by 100 times and sometimes 200 times the amount of silver that has been stored that securitizes those trades. A trading market that is 100 times leveraged on a daily basis, the amount of metal available for good delivery lends itself to a squeeze. Now, people who believe that they're going to get way long the futures and engineer a short squeeze ignore the fact that futures markets are engineered for the benefits of the market participant, which is to say that they will halt the silver contract and they will cash settle. There will not be a circumstance where the silver price goes to $1,000 and all the shorts get busted because they can't deliver silver. That's not what's going to happen. If you have a silver squeeze, what's going to happen is that the contract will be suspended and they'll cash settle. We saw that in the tin market. I mean, that's the way it works. That disruption, however, would, I think, be extremely beneficial to the silver market. People need to understand that. When I look at the silver market, I don't have the same ability to say why it'll go higher that I do with gold. What I do know is that in my 50 years in metals markets, that precious metals bull markets are led by gold. And when the narrative becomes pervasive enough that the generalist investor comes into the precious metals space, market leadership switches from gold to silver. I don't know why, I just know that. I suspect it's because the lower unit cost of silver makes it more accessible to more people, and its reputation for volatility brings in speculators. The least liquid asset class, the most volatile, are the silver stocks, the relatively high quality silver stocks. And when the generalist investor comes down into that space, there simply isn't enough market capitalization to handle the money. And in my experience, they explode to the upside. Will that happen again? I don't know. If so, when? I don't know. But let me give you a couple of observations from history. In the period 1970 to 1980, one little silver share, Coeur d'Alene Mines, began the period at 10 cents and ended the period at $65. Now, sadly, I was too young and too poor to take advantage of that. But we had a pretty good silver market in the period 1989 to 1996. In that period, if my memory serves me well, the silver price went from $4 to 50. Nice move. But the shares of things like Silver Standard, 72 cents to $45. Pan American, 50 cents to $45. These were truly magnificent moves. The consequence of that, Jan, is that although I'm an older guy and much more investment focused, I have about 2.5% of my portfolio in the silver stocks. It wouldn't surprise me, I'm not counting on it, but it wouldn't surprise me to see that 2.5% of my portfolio become 20% of my portfolio with no capital addition. If it doesn't, if it stays where it is, or even if it declines, it's not going to change my decision as to what to have for breakfast. But if past is prologue, there could be an awful lot of performance in that sector. And the right speculator, the one that's willing to work hard, that's willing to endure volatility, that's willing to accept real risk, having acknowledged that that person is speculative, needs to consider the silver space.
Mm-hmm. Very good. And Rick, I think that brings us to our main topic, the junior market in general, right? When we talked about this, you said in the 70s, you haven't had enough money to participate in all the speculations, but now you're sitting here and you're a legendary investor and everybody knows your name in the US, Canada, or even here in Germany. So something changed in the time between, right? From having no money to being a legendary investor. And I guess junior market was part of it, right? So you said the best thing is to focus in the silver space, for example, on the relatively quality stocks. So give us a couple of examples. What can investors do when they do their due diligence to find the quality stocks, the stocks that really can stand out and bring wealth to you and your family?
What you say is true. All of the money that I now invest carefully, I made by speculating aggressively. Now, I had advantages. At that period in time, I lived in Vancouver. I had superb access to information, and I worked very hard. I would caution your listeners that the measure of how aggressive they can afford to be is how hard they're prepared to work. I would suggest to people that the number of speculative stocks in a portfolio correspond with the number of hours per month that the speculator proposes to work understanding the stocks in their portfolio. I don't mean, by the way, reading the Financial Times or watching some financial channel on TV. I mean reading quarterly reports, reading resource statements, reading insider filing statements. If you're prepared to work 10 hours per month, then you should limit your portfolio to 10 stocks. Frequently, Jan, when I grade portfolios, I see people owning 65 or 70 stocks. And I know for certain they're not spending 65 or 70 hours per month on those stocks because of the questions that they ask me around those stocks. So speculation has been extraordinarily good for me, but I have extraordinary access to information. I have 50 years of experience. I have a tolerance for absolute loss, and I have ice water for blood when it comes to volatility. A 15% up or down move in a junior equity index doesn't matter to me. It's as though my portfolio were inhaling and exhaling. It just doesn't matter. And investors and speculators need to do a personality audit as to how much volatility they can stomach, how much risk they can endure, and how much work they're willing to do.